Okay, good afternoon. Yeah, good evening. Um, how are you guys doing today? I hope you had a wonderful day. So you're welcome to another of our classes. Tonight, we're going to round up on IFRS 15. My plan was to immediately commence IFRS 8 immediately, but I would want to spend just 1 hour for this class tonight. So most likely I'll round up IFRS 15. That will be the best we will do for tonight. So next week we would continue with IS 8. So remember last week we looked at IFRS 15, and this standard talks about revenue. I mean, the importance of revenue for any organization cannot be overemphasized. So it's important that it is properly accounted for, and which is why this standard actually came up. So this standard came to improve reporting for revenue. And if you remember last week, the way I started, I told you the core principle of IFRS 15. And the core principle is that the revenue that is recognized in the statement of profit or loss must show the consideration expected by an entity from the transfer of promised goods or services. That, that statement, that sentence shows that what we want to see as revenue in your books should be the money you're expecting from the services you have delivered. If you have not delivered a service, if you have not delivered a good, you cannot recognize revenue. That is the core principle. Revenue in the statement of profit or loss must depict the consideration expected from the transfer of goods or services to customers. If you have not delivered goods or services to customers, you cannot, you should not recognize revenue in the books. That's the core principle. And in order to achieve that, this standard came and said that for you to recognize and measure revenue, we use a 5-step model. Last week, we were able to cover up step 1 to step 3. Tonight, we're going to finish step 4 and step 5. And I'm also going to look at some practical applications that was given by the standard that are highly testable, which we're going to quickly run through as soon as I'm done with these steps. So I started with step 1, and this step 1 deals with identifying the contracts with customers. We explained this thoroughly. I told you about the elements that must be present in a contract for it to be a contract. We spoke about the parties must have agreed to the contract. We spoke about the payment terms must be clearly defined. We spoke about each parties must know their rights in a contract. We spoke about we must be sure that we're going to receive our money, and also there must be commercial substance. These 5 must be present in a contract, and all 5 must be there. And also, I told you that if you have a contract in which all these 5 are not present, such a contract cannot fly. In fact, you cannot recognize revenue from such a contract. I told you that if these contracts, if these characteristics that we mentioned, if they are not all present in a contract, you cannot recognize revenue. You cannot put the money you receive as revenue. Instead of crediting revenue with that money that you have collected, you instead credit a contract liability. We're going to emphasize a little more on that today. Also, we moved on to we talked about contract combination, we talked about contract modification, and we spent a lot of time on this with several scenarios and examples. If you have had time to look at it, then you would have no problem understanding it at all. We also talked about identifying separate performance obligation. In a contract, when a contract is signed, there is always the rights of the parties. The right of the seller is to deliver goods. See, the promised goods to be delivered in the contract to that customer is what we call performance obligation. Step 2 says that you must identify the performance obligation that are separate, which means that if you offer a bundle of service, if your contract carries many services, so you need to be able to identify whether those services should be seen as one or you should separately identify each of them. And we said the way to determine whether when you're offering many services or a bundle of services, you're going to see all those services as one or you're going to see them as separately. You said the defining determination is looking at whether they are distinct. And when we say they are distinct, it means that those services, those goods or services must have a distinct function and a distinct profit margin. If they have a distinct function, which means that the customer can benefit from these goods or services on their own. If it has a distinct profit margin, which means that these goods or services are separately identifiable. That is, they are not integrated into other goods or services. They are not dependent on other goods or services. So we are looking at a good or service that is distinct, that has a distinct function and a distinct profit margin. We gave scenarios and examples to let it make sense to you so that you will see what we mean by distinct function and distinct profit margin. And ultimately, you will see that the guiding principle is that if you have a goods or services that is not dependent, that customer can use on its own, you identify such goods or services as separate. It's separate. You don't bundle it with other goods or services. Then we looked at determining transaction price. You see, this transaction price is this consideration you are actually expecting. This is the money you want to get from the customer. And this transaction price, you must ensure that you never include the money you receive or you want to collect on behalf of third party. Never include VAT as part of your transaction price. Never include VAT as part of your revenue. These are money you are expecting and you're going to deliver to the government. It is not your revenue. When it comes to transaction price, I told you that this transaction price can either be fixed, which is the simplest form of transaction price you would have, and which is the common one, whereby you would put on your invoice how much you're expecting, fixed amount, whether 100 million, whether 200 million, it is fixed. That one is extremely straightforward. Alternatively, you can have transaction price that are variable, in that you have promised the customer that you're going to give them some discounts, some rebates that would ultimately reduce the transaction price. When there are variable consideration, such variability must be factored in the determination of that transaction price from day one. If the money you are expecting will reduce as a result of non-performance, if the money you are expecting will reduce because you have promised to give a discount to your customer, you need to factor that in from day one. because it's going to impact your transaction price. Additionally, we also say that transaction price can also be affected by time value of money, whereby there would be a significant financing component. And that occurs where you sell on credit to a customer and the credit period goes beyond 1 year. When the credit period goes beyond 1 year, we believe that is similar to giving the customer a sort of credit, a loan. So ultimately, if the customer then pays you your money, a portion of that money that you collect must be apportioned to interest income. So you will not put everything as revenue, you will put a portion as interest income. And the way it's done, like I told you last week, is that the money you're expecting, you are going to discount it to present value. Then the present value is what we show as revenue. While the difference between the present and the future value would be an interest income. It will go in as a finance income. Also, when you have a scenario where you have promised to pay some consideration to the customer, we have a lot of wholesalers that would promise their retailers that will give you some money if you help us market our product. I did that as an example to you. Such promise to pay, such payment to such a customer would automatically reduce your transaction price. These are all what we discussed in depthly, in detail last week, and with some scenarios. So this week, intentionally again, I did not bother you guys. I did not give you assignment. I did not, on the assumption that you have a lot on your plate to study. You have a whole lot. I was going through your past questions today, and I can see that it requires a very good knowledge of accounting standards, a very good in-depth knowledge. You need to understand all of these things that we are teaching you, not on the surface, but so well. So very well. Now, let's move forward. I have used almost 10 minutes for revision. I think it's worthwhile. Now, today, we're going to start from step 4. And step 4 talks about allocation of transaction price to performance obligation. Allocation of transaction price to performance obligation. You see, remember, I told you that a contract can contain more than one distinct performance obligation, especially when you have an entity that is rendering a bundle of services. If an organization is rendering a bundle of service, and meaning they are offering many services, that's what I mean by bundle of service. They are rendering many services and it's there in the contract. They want to offer service A, service B, service B, service C, like almost 4 services in the same contract. And you are an accountant. When you looked at each of these services, you saw that each of them are distinct because they have distinct function and distinct profit margin. You see, when you identify they are distinct, step 2 says that you must identify them separately, which means that you must recognize transaction price on each of them. If it has not been done in the contract already, you must recognize revenue separately. Don't bundle everything together. If you see that they are distinct, you must recognize revenue on each of them. So the challenge is that in most cases, all of these services will have been bundled and there will be a single price for everything. That is a major challenge. If there's a single price for everything, so how do you then recognize revenue for each of these services? So if it's a service that each of them, you also supply them unbundled, meaning that you also supply them separately, which means that you can easily know their prices. But if you don't supply them separately, that means we can find a way to get their market price. So the core thing is this. There is a terminology they call standalone price or standalone selling price. So would expect that you would recognize each of the services based on their standalone selling price. So if you bundle goods together and you price them at a single price, you want to offer service A, service B, service C, service D, and you told the customer that for all these 4 services, pay me 10 million. The key question here in step 4 is that if those services, we have defined them as separate, as distinct, how do you then share that 10 million amongst them? Because IFRS 15 requires that you need to separately recognize revenue on each of those services. The standard says that you need to find their standalone selling price. You can get it internally if you supply those services separately normally, then it's easy for you to get their standalone selling price, because their standalone selling price is how much you sell them to other customers normally. It is on that basis that you are going to share that bundled price. I mean, in love of the English, let me show you cases so that you can see that allocation live. So let's look at case 1. This guy offered software and support services bundled. So a company sells a package for 10,000 naira. And this package includes software, 1 year technical support. So the software is delivered immediately. The 1 year technical support, that one is delivered over time since it's a 1 year technical support. So luckily, they gave us the standalone selling price of these services. Now, software, if you were to sell it separately, it will have been 8,000. 1 year support, if you were to sell it separately, it will have been 2,000. So here we can see that the total standalone selling price, this SSP standalone selling price, is 10,000 naira for the bundled. Now, to allocate, this one is very straightforward because is 10,000, and we know that 8,000 license, 2,000 supports. So ordinarily would expect that for the software, we'll do a kind of proration. So we'll do 8,000 over 10,000 times the pricing in the contract. Remember, it was 10,000. The entire service was offered for 10,000. So we're able to get their standalone selling price. Software 8,000, the technical support 2,000. So we're going to share this 10,000 on the basis of this 8,000, 2,000. So even this one is very straightforward, because even without doing this proration, right, since they both add up to this 10,000, so the ending result will still be 8,000 and 2,000, even without doing all of them. But I just want to show you this because of the ones that will be complex. This is how you still do them. So you are going to prorate this 10,000 price in the contract on the basis or in the proportion of their standalone selling prices. You allocate this transaction price because the 10,000 is the transaction price. It will be allocated on the basis of their standalone selling price. So since the standalone selling price is 8,000 and 2,000, so for software, it's just 8,000 over 10,000, which is 8,000 plus 2,000. Okay. multiply by the transaction price. For 1 year support, 2,000 over 10,000, multiply by 10,000, which is the workings I did here. So the revenue you recognize for software will be 8,000. The revenue will be recognized for support services will be 2,000. This is what we mean by allocating this transaction price based on their standalone selling prices. So, I mean, since the software is delivered immediately, so we recognize this 8,000 as revenue immediately. But you see this 2,000 1 year technical support, it will be very wrong to go and put the whole of the 2,000 as revenue. But rather, what we do is we're going to spread it over time. We'll recognize it over 12 months, the 2,000. Okay, I think I will still talk a little more around that. Now, let's look at another case. So we have a gym seller. Okay, the guy does 1 year subscription for 1,000 bundled with personal training sessions of 300 naira for a total package of 1,200 instead of 1,000 if sold separately. Okay, you get the idea. So if ordinarily 1 year membership is 1,200, personal training session 300, but if you want the two package, so the guy said he can give you the two package as 1,200 instead of 1,500. So that means as far as this contract is concerned, the transaction price is 1,200. And there are more than one service here. There is the 1 year membership and there is the personal training. So we need to recognize each of these separately. Now, unlike this other one, where the individual service, their prices was summing up to this 10,000. In this second scenario now, which is the scenario you will find in the exam, is not summing up. The total price, the transaction price in the contract is 1,200, but the prices of the services in the contract, you see, membership alone 1,200, personal training 300. So that means the total standalone selling price is 1,500. So very straightforward. The core thing is knowing what the transaction price is, which is the total package, 1,200 as specifically mentioned in the question. So what we do is that this 1,002, we're not going to apportion it. We're going to allocate this 1,002 on the basis of the standalone selling price of each of those services in the contract, which goes to show that membership, okay, will get 1,200 over 1,500. This 1,200 is the standalone selling price of membership over the total standalone selling price multiplied by the transaction price, which is how much we sold the package to the customer. Remember, it is this 1,200 we are sharing. This 1,200 is the selling price. But having discovered that there are more than one service in this contract, we need to share this 1,200 between those two services. And the ratio of sharing is their standalone selling prices. And they have given it to us, 1,200 and 300. So using ratio, so membership will get 1,200 over 1,500 multiplied by the transaction price. If you press your calculator, that gives you 960. While training will get 300 over 1,500 multiplied by 1,200, that gives you 240. Of course, if you add this 240 and 960 together, it gives you back the 1,200, which goes to show that the 960 is what we're going to recognize for the annual membership. But since this is the annual membership, that means it is expected that you should recognize this 960 over 12 months. You should recognize this 960 over 12 months. While the 240 for training session that we allocated to training session, is as the training session is provided. we recognize it. That's the idea of allocating transaction price in the proportion of standalone selling prices. Look at this one. So a company sells a bundle for 50,000 naira, and this bundle includes software license. The standalone selling price of the software license is 40K. Customer training, we don't know the standalone selling price for that. We don't know. But what we know is that these two services, the company sells them for 50,000. This one is straightforward. Since we have identified that these are separate services, okay, the software license, we recognize it at 40,000. Then the customized training, since we are doing the two at 50, we can assume that is the balance is 10,000. What we are just trying to do here is just, what this guy wants to do is each services you must allocate money to it separately. Don't bundle everything together and recognize just 50,000. The 40,000 belong to software, the 10,000 belongs to customer training. We really want you to separate it in that manner. We really want to separate it in that manner. So, and that's how this is going to fly. Okay. Any questions, please? That's all for allocation. Any questions? Let's ask questions. Today we want to be finishing very, very soon.
Yeah, Mr. Wasim.
Yes, sir.
Yeah, concerning this 10,000 that will be recognized over time as training is provided, I don't, the practical aspect, I would like to see how it is done. Like, since it is for a year, because be
Just
recognized
divide it by
over time,
12.
like,
Just divide it by 12.
okay,
So you're recognizing it per
okay,
month.
okay. Likewise for the software too, right?
And the software is given once. They give him the license. So we
Okay,
will
okay,
give the client the license immediately. So the 40,000, we have delivered the service. So the
mm,
40,000 is recognized immediately because we have delivered the service. But the
okay.
training session, or which is over 1 year, or over time, or customization, or the key idea is that you recognize revenue over the period at which you'd offer the service.
So the same thing goes for the other question too. Member and training, 960 over
Yes,
12 months, 40 over 12 months.
exactly.
Okay.
Yeah. It will be clearer now because that's what step 5 is actually talking about, recognition of revenue. So this one is just jumping. The main principle here in step 4 is just how to allocate that transaction price in the proportion of their standalone selling prices. Is the whole idea of step 4 is to know that you recognize revenue separately for each service. So if you have more than one service in a contract, don't just say, this is our revenue. No, we want you to recognize revenue separately for each services that are distinct. That's step 4. Now, this is just a long question. I've already taken care of it for my explanation. Now, step 5 is the one that actually says, okay, then recognize revenue. Step 5 is when you recognize revenue. Okay, now let me now explain what Momo was asking. Is step 5 that actually takes care of that. So generally, when we want to deliver goods, or put it technically, when we want to satisfy performance obligation, is either we satisfy that obligation over time or at a point in time. So you recognize or satisfy performance obligation over time when it takes a long time for you to deliver those goods or service, but at a point in time is when you deliver the goods immediately. So, and it is in that manner that you'd also recognize revenue. If your services are rendered over time, revenue is expected to be recognized gradually as performance obligation is satisfied over time. Just like when you are handling a construction project, or you're providing a software as a service, or you're having a 1-year gym subscription, or you are into consulting, you are carrying out audit services, and your client paid you $1 million for 4 or 5 months. You can't just jump to recognize the whole money now. It's just like our school now. We can't recognize revenue in January that, okay, you have paid. No, it's wrong. Since the service is over time, the revenue will be recognized gradually, also over time. I will show you how that is done. But this one, at a point in time, this is majorly for over-the-counter services where you just go like retail sales. You walk into a supermarket, pick up some goods, or you went to buy a car, a machinery, or you bought a house, a ready-made house. I mean, all those, you deliver the service immediately at a point in time. You deliver the service. So in this instance, revenue is recognized when the customer has control over the goods. As soon as the customer has control over the good or services that is transferred, you recognize revenue. So this is the core of step 5, how you recognize revenue. So we need to look at how is the service, how is the performance obligation satisfied? If it is satisfied over time, you recognize revenue gradually as you are satisfying that obligation. If it is at a point in time, you do the same thing. So you see, when we say an obligation is satisfied over time, I mean, I can explain it in 3 scenarios as explained in the standard. The standard says that usually this type of services, you find out that the customer simultaneously receives and consumes the benefit as the performance is taking place. Just like this, our class. You are enjoying the service as I'm teaching you. So provision of service and the benefits is occurring simultaneously. So they simultaneously receive, or you receive service or benefits as performance is taking place. So like example is a tutoring service like we are now, or even a cleaning service where the customer benefit as the service is provided. When you have such service of such nature, it means you have to recognize revenue over time because the obligation is satisfied over time. Another one is, which is also show that obligation is satisfied over time, is where an entity's performance creates or enhances an asset that the customer controls as the asset is created. Okay. Example is when you are constructing a building on a customer's land. So this, you are creating an asset, and as you are creating it, the customer controls it gradually. As the asset is created, the customer will be taking over the control gradually. Just like you are helping him put a structure in place. That is showing you are performing over time. Or where the asset you have created does not have an alternative use, like where you manufacture an highly customized machine for a customer, it takes time to get these services ready. You don't have to cram all of this because nobody is going to ask you this. the core of this is that you should be able to articulate when performance is satisfied over time. You should be able to see it. And the core of it is that it takes time. Takes time. I mean, you can measure it with how long it takes to deliver the service. And when you have performance being satisfied over time, it means that the revenue also will be recognized over time. And there are two methods. Is either you use output method or input method. Output method, because when we say you are recognizing over time, how do you do it? Which was what Momo was asking the other time. So output method is you look at the output, the direct measurement of the goods or services, right? By looking at, okay, the milestones covered in the contract, the units produced, the work performed. Another method is input method, by focusing on the costs or the efforts you have put in. And this input method, you can look at the cost to cost method, like how many labor hours you have put in and all of that. An example of output method is a company is constructing a bridge for 10 million naira. Okay. You recognize revenue when key milestones are met. For example, now, if foundation represents 20% progress, it means that you can recognize 20% of your revenue. That's output method. That, okay, what's your progress to date? Then you can use that as a basis for revenue recognition. Can use that as a basis for revenue recognition. Another one is input method. By looking at the cost you have incurred to date. So if a company expects that the total project cost is 5 million to build a factory of 8 million. So if 1 million has been incurred to date, so the revenue you can recognize is the cost you have incurred to date all over the total costs of this project multiplied by the contract price, which is 8 million. So you are looking at the input method, the cost to total cost. How much cost have you incurred to date? What is your total cost you will incur? Then multiply that by the total revenue. So you are only, out of this 8 million, you can only recognize 1.6 million. Majorly, that is how you recognize revenue. Is it that you are using the output method that looks at the production, that looks at your achievement, your performance to date over the total expectation. But the input method focuses on the costs, the input. And you're going to use that basis to know how much revenue can you recognize at a point in time or till a point in time. This one is very straightforward. Recognizing revenue at a point in time is quite straightforward. Because for this one, as soon as the customer obtains control of the goods, recognize revenue. As soon as the customer obtains control, recognize the entire money as revenue. Is that straightforward immediately. And some indicators of transfer of control are if the entity has a present right to payments for the assets, meaning all you're expecting is just money, payment. The customer already has legal title. The entity or the seller has transferred physical possession of the asset, or the significant risk and reward of ownership have been transferred to the customer. They can ask this in your exam. You have to know these are things like this. You need to put it in your mind. Has present right to payment, legal title to the assets. You know what I mean by legal title? I mean, legally is the owner. The customer is legally the owner of the asset. Or the seller has transferred ownership, physical possession of the asset to the customer. Or the risk and reward has been transferred to the customer. This shows that the customer has control over the goods or services. An example is, if I go to a store and I buy a laptop for 1.5, the customer pays immediately and takes the laptop. The store can recognize revenue immediately because the customer has paid, legal title has transferred, physical possession has transferred, risk and reward has transferred, recognize revenue. Or you sold machinery but with installation. So a manufacturer sells machinery of 100,000, and this 100,000 includes installation. So if you identify that installation is a separate service on its own, that means that it's only the revenue relating to machinery that we can recognize now. The revenue relating to installation, since we have not delivered that service, since we have not installed, so we are going to wait until after installation before we can recognize revenue on installation. But if installation, if we were told that is essential to functionality of the machine, if it is essential to functionality of the machine, we'll just wait to until we install before we recognize the entire revenue. So I saw one person wrote one-off transactions, yeah, something like that. Okay, but I mean, like this one now, where there is installation now, so you need to properly look at it. So because the one that you sell the machinery, if the customer can go and install on his own and all of that, so just recognize your own revenue for machinery. If the customer can still be using it without finishing installation, but if installation is essential to functionality, that means you can only recognize revenue until after installation because they are single performance obligation. Another one, a company provides a cloud-based accounting software subscription for 12,000 naira per year. So the customers pay annually in advance. Okay. So you see, if you work with such a company, you cannot recognize the 12,000 you receive as revenue. To be very wrong, because the customer pays annually in advance. So at the beginning of the year, you pay your 12,000. It's just like all these internet service. Some people pay annually, right? So those internet companies, if they have good accountants, they must not recognize the all of the money they receive as revenue immediately. That would be very wrong. So the right thing to do is that at the beginning of the contract, where they receive that money, they will debit the money they received. Instead of crediting revenue, they will credit a contract liability. They will credit a contract liability because revenue is unearned. So, Christopher, I believe I've answered your question. So, you would credit a contract liability. So, every month, as you are offering the service, you'll be, since it's 12,000 for 1 year, so 12,000 divided by 12 months, That means you are going to be recognizing 1,000 naira every month. So you simply debit contract liability, you credit revenue. You debit contract liability, you credit revenue every month, every month, every month. You have to know this. This is essential. So every time we go to client office, because we'll find out that they are recognizing revenue for services they have not offered. It is unacceptable. Another scenario, you, you sold with no involvement. So let's say a company sells an apartment for 500K. This one is so straightforward because you sold, as soon as you sell an apartment and you can prove that the customer has taken ownership, customer has made payments, and you have no further involvement, recognize revenue at your point in time as soon as you have transferred control to the customer. You recognize revenue. So that means all those that used to build off the shelf, that used to sell, um, off, all those developers that they will say, come and buy off plan, yes, that used to sell to you off plan, that you buy from them and give them money. That money they have collected, the accountant will be very wrong to record something like that as revenue. It's a liability. It's a liability because they have not delivered. It is until they have delivered that they can recognize revenue. And which is this third scenario. You sold with construction in progress. So you sold an apartment that is still under construction, and the customer will have to pay in installments, and they will have legal ownership as construction progresses. So revenue is recognized over time. So we will find a way, if you can measure, if you can use the output method or the input method, knowing, okay, what's our progress to date? We are 20% to completion, then you can recognize 20% of the contract price as revenue. If you are 50% to completion, then you can put the 50% of the contract price as revenue. That's how it's done. That's how it is done. So there are some key terms that I've mentioned so far. I'm done with all the steps, really. That's everything. That's how revenue is recognized. Now, there are key steps that I've mentioned so far. Number one is there is contract costs. And this contract cost is speaking to cost of obtaining and fulfilling a contract. So if you have to incur some costs in order to deliver or get a contract, like probably you paid some people commission to help you get a contract, you recognize that as contract costs. And after you have gotten the contract, you need to incur costs to achieve the objective. Then, so the key thing is that this contract costs, are you expensing it or are you capitalizing it? So the key thing is that for most contract costs, and this is speaking to, I mean, when you have to, it will take a long time to deliver the project. So all the costs you are incurring, you should be capitalizing them. You will be capitalizing them. Let's say you are doing a job for a customer. All the costs, you'll be accumulating it. It's assuming that you have not collected your money. So as soon as you are collecting your money, then you can then be expensing that cost. You can be expensing it to P&L so that you can be matching the cost with the revenue. So contract cost is the cost of obtaining and fulfilling a contract. They are usually capitalized. So as you are collecting your money from the customer, you can, on a systematic basis, be expensing that cost as well, so that you can match that cost with the revenue. Another one is contract assets. A lot of people usually mix this with trade receivables. Up to date, I've never seen most of my clients, I'll find out that they call everything receivables. They don't separate contract assets from receivables. And they are very different. Because contract asset is when you are expecting money from a customer and your money is conditional on some services, is conditional on some future performance. You are expecting, you have delivered the service, you have done your work, but you are expecting money from customer, but the customer expects that you are going to do one or two things for him. Probably the customer is expecting an invoice from you. Probably the customer is expecting something in the contract that you have not done. Yes, you have delivered the service, but your money is still conditional on some other things other than passage of time. They still expect you to do one or two things. Especially you have delivered service, probably you have not sent an invoice. That's a contract asset. That money you're expecting from that customer, we debit contract asset and credit revenue. The almighty receivables, which is the popular one, you only debit receivables, you call the money you're expecting receivables if the money you're expecting, which I call here your right to consideration, is unconditional, meaning you have delivered the service. That the only thing between you and your money is just passage of time. It's just passage of time. That's receivables. It's different from contract asset. So hopefully, I will send you some scenarios, and I would expect you to tell me which of them is contract assets, which of them is receivables. I'll send you like 10 scenarios just for you to be able to identify the differences. Also, another one that is very similar is standalone selling prices and transaction prices. So standalone selling price is the price at which you will sell promised goods or services separately to a customer. That these goods or services, how much do you sell it to every customer? How much do you sell it? What's the selling price? That's the standalone selling price. The price at which you will sell a good separately to a customer. But transaction price, this is the amount of consideration that you are expecting from the exchange of promised goods or services, or from the transfer of promised goods or services, excluding amount collected on behalf of third parties, that is VAT. Transaction price is the contract price. Transaction price is the money you're expecting. It might be different from the standalone selling price. Standalone selling price is okay on a normal day. How much do you sell these goods to customers? Transaction price is the agreed price. transaction price is what you're expecting from the customer. You might not be expecting the selling price. Perhaps maybe you have given him discount, or you have promised him to pay him some money, or there's time value of money. So a lot. I told you about what affect transaction prices like that. So transaction price and selling prices are not the same. So these are terminologies that is expected that you should know, which can ask you. Can we say that transaction price is the market value? No. But we can say that standalone selling price is the market value. Transaction price is just the contract price, is the agreed price, is not the market value. Okay. Now, let me put it all together. So, in essence, when you sell goods to a customer and the customer pays you money, or you receive money from the customer and you have not delivered the service, do not recognize revenue. Rather, you recognize the money you received as a contract liability. You recognize the money received as a contract liability. Also, when you have delivered, let's say you have delivered the service, but you did not give invoice to the customer, or probably the customer is expecting hard copy, or probably the customer is expecting something from you, and you have delivered the service, and the customer hasn't paid you, customer is owing you. See, that money that, that you can credit revenue, but what you debit in that instance is a contract asset. So as soon as you have performed, you have delivered the service, but your payment is still conditional on a performance. It's still conditional on a performance. Such payments, such money you're expecting, you debit it to contract asset. But if your money is not conditioned on anything other than passage of time, then receivables. The core disclosures for revenue, number one is you need to disaggregate revenue. You need to break down revenue by geography, product line, contract type, customer type, products. Break it down. You need to break down your revenue in the notes. So when you put revenue, this amount in your notes, disclose the breakdown to us. You need to tell us the balances separately. Separate contract assets from contract liability, from account or trade receivables. You need to also tell us the judgment you have made in terms of where there will be variation in consideration, if there is a contract modification or combination, how you derive standalone selling prices. This requires some judgments. You need to disclose. These are disclosures that need to be made. Also, you need to tell us whether the revenue is recognized over time or at a point in time. And when you render a service bundled and you have allocated the transaction prices, you need to show how revenue is allocated among those services. How did you allocate revenue? Okay. So my time is up, actually. I've spent my 1 hour. Now, for those in FR, this is really none of your business. It's not in your handout. They won't ask you. So all the above are for you. For those in CL, this is a lot of your business. They can ask you. Really, they can. So, and it's just, they are just scenarios, but these scenarios are tailored to some type of transaction. So I want you to look at it and let me know if something you can get. If you cannot, I have a recording of this that I can share with you. So the past questions, the questions they have asked so far has been a little easy. I mean, the last time, which is May 2023, one of the questions that was asked is discuss the criteria that must be met for a contract with a customer to fall within two. So those criteria for contracts that I explained to you and all of that, the same thing they have been asking over and over again. Explain the core principle in IFRS 15, which is that you only recognize revenue based on the consideration expected from the transfer of promised goods or services. Explain the 5-step model. Simple questions all along. Explain contract modification. I mean, all of that. Distinguish between transaction price and standalone selling. Those are the questions I kind of been asking.